When growth is the name of the game, there's one Vanguard ETF that stands above the rest. That, of course, is the Vanguard Growth ETF, or the VUG. Now, this fund has outperformed the S&P over the last 10 years. And even looking, if you invested $10,000 just 10 years ago, you would have almost $40,000 in that portfolio as of today, putting it at an impressive 294% return over the last 10 years, which absolutely crushes the S&P 500. Before we get into my personal portfolio and show you the growth that we're seeing by investing $1,000 every single week, let's go ahead and break this one down. So the VUG, of course, owns 208 different stocks. Now, majority of these stocks, now, if you're owning the VOO versus the VUG, or even if you have both, which I do in my case, it is because there is a big focus on specific companies, where the S&P 500 fund owns 500 companies. This one only owns 208 stocks, which are based on faster revenue, profit growth, and really seeing this. Now, of course, this ETF has put out an annualized return of 19.6%. That is right. We are seeing an annualized return of almost 20% from this ETF, which is kind of crazy. The average price to earning ratio is 35.6%, which is much higher than the multiplied 22.9 of the S&P 500. And given the growth focus, it's not surprised that 75% of the holdings come from the technology sector. Now, this is where I like kind of the breakdown of, again, owning that VOO and owning that VUG. The VUG has such a strong focus into the technology sector, as well as the Magnificent Seven has 51% of the growth of this ETF in the last 10 years, which is kind of crazy. When you think of that Magnificent Seven, Microsoft, Apple, Nvidia, some of the top stocks within there are just dominating because of artificial intelligence. These stocks have skyrocketed in the last 10 years, which is kind of crazy. Now, of course, with the VUG, it is a little bit more risky because it is in less stocks. However, with the majority of them being in tech and a lot of the other portfolio being in other places, there can be a little bit of uncertainty, but the return is definitely worth it. Does the time in the market make a big difference? Now, if you follow Warren Buffett, it is not about timing the market. It is about the time that you are in the market. And this fund proves it. Again, looking at a massive, massive growth record with this, it is kind of crazy with the highs and the lows that we see. It is about the longevity of the 7+ years when you're in the market. So should you invest in there in the Vanguard Growth Fund right now? Absolutely. When you look at the fund itself, you know, a lot of people even thinking of Nvidia, where people are saying, well, $300 was too high. Well, $500 is too high. Well, $800 is too high. At some point, you got to get in the game and you actually have to start investing your funds. So let's hop over and look at the portfolio and break this thing down. All right, guys, so here we are over on the M1 account. Now, I do have links down below for both Robinhood and M1 if you want to check those out. And if you haven't followed the channel before, we invest $1,000 into this portfolio every single week. And as you can see, we're at about 98K right now, which is kind of incredible. But breaking this down mathematically, you will see that overall, we have put $82,000 into this. We've gotten over $1,000 in dividends in the last 2 years that we've had this portfolio. And we have a money weighted return of almost 58 or just north of 58% return in this portfolio. Now, it's absolutely crazy to see the growth that we've seen in here. Now, of course, you know, looking back at 2022, it was very difficult in the market. We were seeing it decline dramatically. I mean, some seen 20+% losses at that point, but that was the time that we were buying. And honestly, at that point, you can get all of these ETF stocks, bonds, whatever you want to, whatever you're buying at a massive discount, depending on what you're putting your money into, making it a big value at that point. So market gain overall, we're at about 15,000, which is a pretty good return over the last, again, we're going on 2 years, going kind of heading into 3 years at this point. But I am broken it down into 4 ETFs, and these are the 4 ETFs, and I really want to break them down. So of course we have the SCHD. This, when we did it versus the Vanguard Dividend, the SCHD had better returns, had a higher yield. The 1 year, the 5 year, the 10 year, the SCHD did have a much higher return than the other dividend funds that we kind of looked at. Now the VUG, which we were just talking about, you can see even in this portfolio, we're at about a 62% return, which is just absolutely crazy with this growth fund. And you can see out of everything we own in this portfolio, it has been the best performing. And overall, looking at the rest of it, we have the VOO, which is the Vanguard S&P, again in 500 stocks. And then we have the QQQM, which is the NASDAQ 100. So I know some of these do have the overlap, but again, knowing that 51% of the VUG is just based literally into a big chunk. Now there was a point you can see that we actually sold out of this. We moved everything into the VOO at some time, and then we got back into it a little bit later. So that's kind of the variation with this a little bit. But overall, again, when you look at 51% of this ETF itself is in the technology, that is the reason why I did want to go in here and why I wanted to get the VUG, because of the growth factor that it has and the key holdings that it has, but also the percentages. When you look at Microsoft, 13% of this is in Microsoft. We have Apple in there at 12. We have Amazon, Nvidia, Meta, Google. We have Tesla in there. We have Visa. We have Eli Lilly. Very dynamic, very built out. And again, looking in the tech sector, we have 51% of it in the tech sector. So it's a lot more focused than looking at like a VOO with the actual growth factor that we do have in there. When you start breaking out, when you look at the VOO, again, some of the ETFs are a little bit similar, but you'll notice that we do carry some of the, again, the overlap, but it is at a much lower percentage, which is the reason why when we have Microsoft, when we have Apple, the overlap is there, but I want something that is a growth. And of course, having it heavily invested into those tech do make a really big difference when it comes to the portfolio. Now, overall, this portfolio, again, has been doing incredibly well. And then, of course, like I said, we have the QQQM in there. But right now, net cash flow, we are at 83K. Now, we have put 83,000 into this in the last 2 years, just north of, again, 2 years and 6 months? So 2.5 years at this point. So we are trying to get this net cash flow up to that 100,000 once we get to that 100,000, because if we know historically making that first 100,000 is really the most difficult time and the most difficult thing that we can do. So we have been tracking this portfolio every single week and breaking it down. If you remember, this is going back way back, even to 11 of 13 when we actually started tracking the deposits every week. And even looking at the net return of this in its entirety, it's kind of crazy where in the beginning, so I mean, you're talking 3, 4, almost 5 months ago, we're at about a 22%. Then we got into the 30s. Had a couple 40s, grew up a little bit higher, getting into these 50s. Now we're starting to see weeks of being at that 60% plus return. And of course, the net cash flow going up a significant amount. Market gain even started at 43. Now we're up to 15 plus thousand. Now this was 3/11 that we actually did this. So this was last Monday when we actually put it in there. Dividends, again, we know dividends are paying on March 22nd for all of these ETFs. So this dividend number will change a lot at that point. But looking at the growth, so we did see last week, it went down quite a bit. You can see we've had a couple dips. Even looking here, we've had what, 1, 2, 3, 4. We've had 4 weeks in the past couple months that have actually been down weeks, which we were negative. Now, of course, with the VOO and the VUG, we're going to see those fluctuate kind of up and down, just kind of based on the market itself. The SCHD stays relatively stable. The QQQM, again, is another one that can have kind of a little bit of that yo-yo effect. But when you start looking at the longer term, we're looking at this at, again, 2.5 years. Wait until it gets to 5 years, till it gets to 10 years. Wait until it gets to 20 years. Now, ultimately, this is going to be a portfolio that we want to grow over time, really getting the snowball effect, not only putting more funds into this portfolio, but also having the ability to grow this based on the ETFs. Now, overall, we did put Bitcoin in there a while ago, which if we had left it, it would have done incredibly well. But I wanted to own the Bitcoin outside of the ETF. Now, of course, a majority of the ETFs that we have for the Bitcoin ETFs are held on Coinbase, and you don't own the actual tokens yourself. They're owned and held on Coinbase for all of these ETFs. Now, again, something that I really didn't like, where I would rather go in there, invest in Bitcoin and hold the Bitcoin myself versus buying into these ETFs, because we know what we're doing a little bit more with crypto than I think kind of the average individual is. That is just kind of putting into the portfolio. But overall, guys, the portfolio has been doing exceptionally well. Again, we're at a 60% return. I can't imagine what the next couple months and the next couple years within this portfolio are going to bring. So again, we know the VUG does incredibly well when it comes to that investing strategy. We want to make sure that we're continuing to put money in there on a regular basis, growing out this portfolio. Once we get to the 100,000, we're going to go ahead and reassess exactly what we want to do. And we're not going to be looking at the actual balance in there, but we are going to be focusing on the net cash flow in there. Because again, we're about 17,000 away from hitting that 100,000 mark for the cash flow, and then seeing exactly where the balance in this portfolio is, which I mean, I would probably put it at 140, maybe at that point, maybe a little bit more, because 17 more weeks, that gives us a couple more months to actually do this. Now, we started this borrowing on margin. Now, at this point, we haven't had to borrow anything on margin when we've been putting our regular investments in there, which is really cool to see that we've been kind of keeping pace up with it. But again, a lot of that does come from the YouTube revenue from the gaming channel. And this channel is very close to getting monetized. So we're right around the corner, and we'll be able to get this one monetized with about 500 more watch hours. So we're absolutely getting there. And if you're not subscribed to the channel, go ahead and do it. We're going to be focusing in on some investment strategies and also looking at those ETFs, which I absolutely love. All right, guys, so that is going to do it for the portfolio, and I'll catch you in the next video.